The intelligent investor. Overview. Financial markets are very different now than what they were in 1949. This was when Benjamin Graham wrote this classic book, The Intelligent Investor. Stock valuations are quite higher, and saving bonds which Graham recommended are not appealing anymore. Graham explained the market using the image of a character he named Mr. Market. This was a mythical person who provided investors a price at which he'd buy the shares daily. Then he would sell those stocks for more. Graham recommended the investors always to ignore such Mr. Markets. But, today investors are engaging 1,500 times more with Mr. Markets than earlier. Hence, most investors overlook this good piece of advice. Graham may give a skeptical look at the amount of speculative trading today. He would criticize the shift to renting stocks than owning them. This is because short-term ownership of stocks gives little benefit to investors. But, Graham's take on enterprising and defensive investors still hold true. He even predicted the inability of money managers to earn a return higher than the market average. His emphasis was strongly on long-run ownership. This suggests that he would have promoted the concept of index mutual fund. In an interview, he said, investors must try to earn at least average market return from the fund. Only index funds can assure such returns. Graham also agreed that his ideas might not be valid over a long time. But, some of his teachings are evergreen. These include, speculation mostly results in loss. Buy when people want to sell and sell when people want to buy. Research before investing. Homework is a must. Investors are of two broad types. Defensive, these investors plan to save money, make the least possible mistakes, and get a decent return. They also hedge against risks. Defensive investors desire both freedom and safety. Hence, they should put 40% of the funds in savings bonds. Besides, they can put a good amount in common stocks. This serves as a hedge against inflation. Also, they can get dividend income from any rise in stock price. Enterprising, or aggressive, such investors want to buy securities for less than the value. These people might gain by trading on the market average. They select market-beating stocks and growth stocks. These investors buy when the market is down and sell when it is upbeat. When investors try to beat the market average and pick winning stocks, then this is speculation, not investing. But, the other techniques are real investment strategies. Buying undervalued securities might be the surest way of gaining riches. But the investor has to devote enough effort and time to become an expert. Investors ought to have a sense of the past. This way they can place market shifts in hindsight. As most investors don't have such reflection, trends become permanent. Investors must treat investing as a business. Many people in business who are wise in the work tend to lose sight when they see Mr. Market. Smart investors aren't uncommonly insightful or intelligent. Instead, they treat the market as a business. Success in investing is dependent more on character than the mind. The investor should have the courage to avoid urges to speculate, follow the crows and make fast money. Market movements. Speculators try making money on how market shifts. In contrast, investor tries buying great stocks at decent prices and hold them. Market shifts matter just because they give prices at which it's wise to sell or buy. An average investor mustn't wait for the market to fall to buy stocks. Unless prices are very high, you must build a stock portfolio via wise buying patterns. Averaging is one of them. Most investors try identifying stocks which will beat the market in near term. This is like speculation and is not recommended. The stock price entails information on predictions of lower or higher prices. It shows the net effect of such opinions. A value investor may neglect daily shifts in prices. Portfolio policies: defensive, aggressive and enterprising. Investment advisors could be helpful. But don't depend on them for guidance on how to earn a profit. Such professionals can help you get a low risk level with conservative income. They can also give you market and economic information. But, don't rely on the market predictions. Brokers are at the end businesses. They're nowhere close to professional firms like a law firm or investment banker. Hence, they don't see consumers as likely buyers for the securities. How investors use advisors and bits of advice relies on whether they're enterprising or defensive. The former work with advisors and want in-depth discussions and suggestions. But the latter must confine the purchase to high-quality bonds with low risk. They only need straightforward advice about which shares meet the needs. Also, they need to know if prices are in tune with the earlier averages. A well-built stock portfolio isn't very risky for a defensive investor. Though stock prices changed, the investor isn't likely to lose money just because the market falls. They lose value only when they sell at a price less than the buying price. Enterprising investors must believe in their own decisions. They should seek advice only for knowledge to add to the skills, never for any direction. 2 principles of portfolio management are the application to such investors. Firstly, don't buy corporate bonds, as US saving bonds give equal returns at much less risk. Secondly, don't purchase high cadre preferred stocks. It's wise to invest in low-quality corporate bonds and preferred shares if prices are 1/3 below average. Foreign bonds should be left alone. Same applies for common stocks and convertibles with recent great earning performance. New issues are appealing only when they're way below their intrinsic value. The aggressive investors might seek profit by market timing, buying when the market is low and selling while it's up. This is appealing yet risky. Future shifts in the market may not match earlier changes. One benefit of this formula is that it encourages investors to act as contrarians. This way they buy and sell against the crowd. This is a wise way to go. But, other than this, market timing has little benefit. Growth stocks, most investors want to select stocks which will beat the market in the future. Finding stocks which outdid in the past is easy. But predicting upcoming performance is hard. Don't end up overpaying for growth. Buying bargains, preferred stocks and bonds could be bargains when the price is less than average. Common stocks could be a great deal if their internal value is higher than the market price. At times, some stocks sell at less than the working capital value. The secondary stocks of the industry can also be great deals. Market inflates the risk of stocks which aren't dominant in the industry. But people buying bargain stocks can benefit from the high returns on the dividend. Besides, they can also profit from reinvesting earnings and price increases over some time. Special situations like mergers, bankruptcy, reorganization, etc. provide opportunities to make a profit. Stocks are often available at discounts during such events. Rules for appraising stocks. These 11 rules can help both analysts and investors. Number 1. Estimate the earning capacity of a company to measure value. Multiply this correctly and take into account asset value. Number 2. Earning capacity is an estimate of the firm's earnings over 5 years. Number 3. Guess a firm's average earnings over this time. You can do this by averaging bad and good in previous years. Then estimate margins and revenues for the future. Number 4. Adjust previous year's numbers to show any changes in capitalization. Number 5. You should use a maximum multiplier of 20 and a minimum of 8. This allows for changes in earning in the long run. 6. If the value arrived at from earning power is higher than the fixed asset's value, subtract from the earnings value change. We suggest, subtract 1/4 of the sum by which the earning power value is higher than 2 times the asset value. This allows for a 100% premium on tangible assets sans penalty. 7. If such value is lower than the net current assets value, add 50% of the variance to the value measured on earning power. 8. In unusual events, like war, short-term royalties or rentals, adjust the value accordingly. 9. Assign value among bondholders, stockholders or preferred shareholders. Before this'll step, compute the company value as though its capital structure had only common stock. 10. The more debt and preferred stock in the capital structure, the less you can rely on the appraised value. Decisions should not be taken on this value. 11. When the appraisal is 1/3 greater or less than the current market value, you can base your decision on this. If the difference is less, then the appraisal is just a factor to consider in the assessment. Investment is most intelligent when it is most businesslike. Managers and stockholders. Though stockholders possess legal rights over management, practically they're impotent. Stockholders follow the management irrespective of how it performs. Though management is usually decent, there are many cases of dishonest and incompetent management. Stockholders must get serious about using the rights as owners. To be specific, they must do the following. Management efficiency. Management is very crucial in the performance of stock investments. But investors don't have much interest in checking management quality. Even less so in removing incompetent managers. Stockholders should develop an interest in the efficiency of the management. They must monitor the management quality with objectivity. If the return to shareholders falls even though the market booms, then they must seek justifications. The information necessary for such an analysis is available. Shareholders might think those chosen directors which defend their interests. But they should remember that managers select directors. Many biases take place and directors tend to fall in management's favor. Outside stockholders. Shareholders external to the company are outside stockholders. They aren't involved in managing or controlling the firm. Insiders usually manage firms to serve their interest. Many times, even at the cost of outside stockholders. Such bias is most visible in holding companies. In such firms, the stocks are decidedly less valued in comparison to the asset values behind them. Insiders can remove this bias by breaking the holding firm, though outsiders will profit. But managers rarely do this on their own. Hence, stockholders of holding companies continue agreeing with the management that doesn't act for their interests. Shareholders have both responsibilities and rights of control. They must use them wisely. Notable quotes. The genuine investor in common stocks does not need great equipment of brains and knowledge, but he does need some unusual qualities of character. Investment is most intelligent when it is most businesslike. Quote. Nothing in finance is more fatuous and harmful than the firmly established attitude of common stock investors and the Wall Street advisors regarding questions of corporate management. That attitude is summed up in the phrase, if you don't like the management, sell your stocks. Quote. Good managements produce a good average market price, and bad managements produce bad market prices. Only in the exceptional case, where the integrity and competence of the advisors have been thoroughly demonstrated, should the investor act upon the advice of others without understanding and approving the decision made. The intelligent investor needs an ability to resist the blandishments of salesmen offering new common stock issues during bull markets. Some of these issues may prove excellent buys a few years later, when nobody wants them and they can be had at a small fraction of the true worth. Quote. A prime test of the competent analyst is his power to distinguish between important and unimportant facts and figures in a given situation. This matter of choosing the best stocks is at bottom a highly controversial one. Our advice to the defensive investor is that he let it alone. Insiders never suffer loss from an unduly low market price which it is in the power to correct. If by any chance they should want to sell, they can and will always correct the situation first. Quote. It is amazing to see how many capable businessmen try to operate in Wall Street with complete disregard of all the sound principles through which they have gained success in their own undertakings.